Fingers crossed it does actually happen. Let me just exit out there and let me share my screen here real quick here. Can you all see the screen? Over.
Got your screen, sir.
All right, cool. Appreciate it. So welcome, everyone. Colonel Lubchowski here, and you are being recorded. If you have any questions along the way, please just come off your mic and ask them. You can go ahead and put them in the chat. That's fine as well if you feel more comfortable doing that. I will toggle between slides as I go, just to make sure I answer all your questions. And please, if for some reason my mic stops working or anything else, please ping me, because technology is what technology is. I gave a class last week. I think this is the pension brief, and my computer restarted right when I was doing it. So it is what it is. I try to make sure this computer is good to go for today. Fingers crossed it works. Taxes, that's what we're here to talk to. This is part 2 of 5. They do build on each other each time. If you haven't had a chance to, or if you didn't attend the basic savings course, I'm working on getting that recording out there. I just tried to re-record it, so hopefully I'll have it and I'll upload it. And it has great fundamentals and foundations of basic savings, of what you should look for in a bank, why you need to earn a higher interest rate to combat inflation. But taxes are an important build on this because it relates to getting more money in your paycheck so that you have more money to budget with and potentially more money to put into savings. That is why I talk about taxes. And you'll see my slides are kind of dreary because no one really likes paying taxes. I will start with a warning. I did the same thing on Friday. I will not make you rich. This is not a get rich quick scheme. What we're trying to do is attain wealth, and wealth in the end, if we make it or not, it all depends on the decisions we make today. I'm going to hopefully teach you to make smart decisions, save smartly, and put you in the right direction. But what the end goal of this is financial literacy. Next month, April, is Financial Literacy Month. I'm retired by then, don't have access to Teams anymore, so I pushed it a week early, or 2 weeks early. I ask you to pay anything forward that you listen to here, kids, neighbors, troops, anyone who might benefit from this, please do pass it on, because unfortunately our financial literacy in our world, especially the United States, I can say is really poor. So the more we can learn, the better we are. And as G.I. Joe used to say, learning's half the battle, or something like that. So jury, because certainty. In this world, nothing is certain but death and taxes. And that goes back a long time to Ben Franklin. Yeah. So the tea tax, Boston Tea Party, all that stuff, taxes will always be around in some form or fashion. But we need to learn what they are and how to work within the system to basically benefit, get a larger paycheck, deposit it to our checking account, give the government less of an interest-free loan, take credits where we can, deductions where we can, to minimize tax bills. That is the goal. We'll kind of go through a few things of why we pay taxes, because it's always good to understand why. That's why I always like to, when I was physically working, not on terminal leave, I always tried to give my people purpose of why we're doing what we're doing, so they have better foundations of the why, so they know what to do to complete the project. It's always better to give purpose. And what do taxes pay? What tax do you pay? How can you reduce your taxes? And how to get more money in your paycheck? Unfortunately, they are unpopular, and many may argue unfair. I don't know. There's some taxes that I believe are unfair, but you know, what is what? But taxes are a necessity. They are considered revenue. By modern society, we need taxes. We need revenue. It always go back to the greater big federal budget that we all see and we hear politicized all the time. We do have a federal budget. We have 2 parts of the federal budget. We have discretionary and mandatory. Mandatory is your Social Security and your Medicare, which we'll talk about here. Your discretionary is everything else. The DoD budget is discretionary. The federal budget relies on revenue. Revenue can be defined as taxes, tariffs, and any other fees that roll in that the federal government can use to pay for items like the DoD budget. That is why we have to pay taxes. We pay taxes also to get services from our county, local, city, state. That's what they do to get revenue, to do projects, to maintain your sidewalks, to maintain your sewer system, all taxes. To meet these expenses, the government needs that income. We already talked about the revenue. Not sure why I have a blue eye down there in income taxes, but I have it there anyway, so we'll talk about it. Our government will levy it. It could be different levels. Federal governments rely on income taxes. We have federal, state, local. Local can be defined as city as well. Like New York City, for example, has a New York City tax. Yonkers has one as well. There's also sales tax, which the governments use as well to finance things. And if you go from county to county, the sales tax will differ. I'm right on the border in Spotsylvania of Orange County and Fredericksburg City. I can go between the three and get different gas prices. Gas prices have a tax associated with it that goes to the state or local government. It's odd because if Orange County has less of a gas tax, I'm going to go fill up in Orange County. That's just how it works. But all these taxes, including property taxes, all go to, I'm using air quotes, the greater good, so that we can have services as a people. That's just a little history of taxes. You know, that Boston Tea Party, I don't want to say all wars, but a lot of wars issues start with money and start with taxes. What taxes do you pay? We're going to focus on the four main types of taxes that you'll see in your paycheck. Federal, state, so FITWA, SITWA is what we call them in the financial world. FICA, if you remember, if you listen to some of my pension classes, I think Shaquille O'Neal was the one who said, who the hell is FICA and why are they taking my money? FICA is a two-parter, Social Security and Medicare. And then, you know, although you see BAH and BAS, you know, basic allowance for housing and basic allowance for subsistence are not taxable, you might see some other taxes within your realm based upon pay. FITWA will still apply, SITWA will still apply, FICA will probably apply on those pay taxes. I just want to make sure you understand that within our military pay system, anything that ends with pay is taxable. Allowance means non-taxable. There is actually one allowance that is taxable, but only generals and chiefs, like high chiefs, like command chiefs. It's the personal money allowance that when you make those higher ranks, you get extra money in your paycheck because you're expected to do things above ordinary people. They get some money called a PMA, personal money allowance, but it's taxed. It's one of those oddities. But just in case you wanted to know, anything with pay is going to be taxed. And BAH and BAS are a great thing to have because a lot of our compensation is not taxed. I'm going to talk here about, let me toggle back here and make sure there's any questions before I go on. All right, I don't see anything. These are income tax tables. When you get paid, you are only getting taxed again on your basic pay. And if you have any other pay in, for example, if you're a pilot, you might have special pay for being a pilot. That's going to be taxed as well. You all come to a tiered rate. If you're single, if you're married, filing joint, or head of household, these are the three main tax brackets or classifications that we have. And we are all taxed on a marginal tax rate. If you ever heard that term, marginal, it's incremental. And I have an example on the next slide that'll kind of show you through it. But we're not all taxed at one rate. So for example, if you're a single filer and you make $115,000 a year, talking about pay, not housing, not subsistence, we're talking about basic pay, you make $115,000, you're in the 24% tax bracket. You can see you're going to be right in here. That means you're not taxed at 24% for your whole money. You're taxed incrementally, marginally. Like your first $12,400 is taxed at 10, and then you go there from that to that, then that to that, and then eventually you get to 24. So only the money from 105,701 to 115 is taxed at the 24%. It's a more fair rate, I would say, as a normal taxpayer. For those who are the wealthy, we would love to see them just taxed at the 24% because they can afford it. But again, they are allowed to have the tiered rate as well. And if you're married joint, you can see the incomes differ. So they allow for that second income. That's why they're larger. So it's the 115, instead of going from 105 to 201, it's 211 to 403. It's compensating for the two incomes that are coming in there. And head of household, it's kind of similar to single, but it's a combination of, for example, if you were a widow, or you're just a single mom or single dad, you'd be in the head of household scenario, and they allow you some flexibility because of your situation. They'll kind of tax you less. But just make sure you understand how you are taxed, so that when we get to how to reduce taxes, I say it with air quotes, reduce, you understand that it's marginal and you're not taxed on one rate. So here's an example of a married filing joint if your income is 150 in 2026. So how they would actually compute it is your first $24,800 is taxed at 10%, so you owe $2,480. And then your next is taxed at 12%, so $9,000. Then the rest is taxed at 22, $10,000, boom. So your tax bill is $22,424. And there are ways to reduce that tax bill, and we'll talk about that. So this is just a very basic pure math scenario. It doesn't take into consideration anything else in the tax world, but just understanding the formula is understanding the math fun, because taxes is a math problem that actually has a number that makes sense. I don't like doing calculus. I don't like it when there's letters in my math problems. My wife is a math teacher with a math degree, understands all that advanced calculus stuff. I love doing taxes because I can get to an answer. It's very simple. It has a nice answer. State, SITWA. State is very complex. I can't give you one answer for state because of all the different rules, and all the 54 different states and territories will have their different rules. If you are in a state that actually has state tax, you have to go to their website to learn their rules. There's a lot of little rules that your finance office should have told you about when you first processed at your base, wherever you were assigned to, about different tax rules when you're in state versus out of state. There's all these different things. For example, I am a New York resident. That is where I'm from. New York has a special rule called the three-prong test. You can't own property in New York. You must live outside the state, and you must not be in New York for more than 30 days in a given year, being active duty military. If you meet that three-prong test, you don't pay New York state taxes. So being a New York resident, I do not own a home in New York. I live in Virginia, and I'm active duty military. When I retire, 31 March, I can no longer be a New York state resident because I do not live in New York. I must become a Virginia state resident. Virginia has their own rules, which I'll be looking into. I believe my $48,000 of my pension is exempt from state taxes in Virginia. Different states have different rules. Vermont, for example, I'm a Vermont Guardsman. I was a Vermont resident for a while. When I do annual training or ADOS or anything outside the state of Vermont, they will not tax that. So they'll only tax things that you've done inside your state. A lot of states will exempt your drill pay. I see that in a lot of different states. They'll say, hey, thank you for being a part of our state militia, right? We will not tax your drill pay, so there's an exemption. A lot of these are income-based because if you're making a lot of money, they're not going to be sorry for you. It's more for the younger folks, the lesser ranked folks who make less money. But I do encourage you to look at everyone's state tax that applies to you. and see if there's military caveats. There's some good online calculators that help you get numbers, but they're kind of generic. Like the smart assets that I use in my pension thing will just, for example, when I put my 22551 zip code for Virginia in there, it's going to give me a basic number, but not any of my special rules will apply. I have to learn to do that myself. If you have any questions about your particular state, I do encourage you to email me. I love taxes. I am VITA trained. I am IRS trained. It goes years back, but taxes are taxes. I still remember how to do all of them. Happy to help you with a situation. If it gets too complex, I can't help you because it would be very tough to, but I do encourage you, if you have problems. I'm not sure if Andrews offers volunteer income tax assistance anymore, normally run through the JAG office. There are trained representatives that can help you with your taxes. There's Military OneSource that you can reach out. H&R Block is free for military through Military OneSource. You can always reach out to them to see if they can provide any assistance. States are always difficult. For example, my oldest is now a New York State resident. They were a Virginia resident when they graduated college. So this year, I helped them file their taxes, basically. I mean, I did their taxes for them. I had to file both Virginia and New York State for them within the system with particular dates so they could actually file and get their federal refund and their state refunds. Filing is very interesting. There are some states that have no state income tax. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming do not have a state tax. Going back to revenue, we talked about a lot of those states that don't have state taxes make it up somewhere else. New Hampshire, for example, I can attest to this one, has very, very, very high property taxes. That's how they offset their no state income tax. And they have no state income tax in general for everyone. It doesn't exist. They're most likely going to have a higher sales tax to make up for that as well. And each one of these states I'm not going to get into, but I do encourage you, if you're one of these states, hopefully you're not paying state taxes at all. Check your record, check your pay. You shouldn't be. If you are getting taxed from the state on your LES and you believe there is a military exemption for you, you're going to have to work with one, if you're stat tour, you're going to have to work through Andrews because they're the ones who control your pay. So the 316th Comptroller Flight or Comptroller Squadrons, you'll have to reach out to them and they can assist you. In NGBFM, we do have a section that can assist, but we do not process transactions. It all has been done to the 316th. If you are an ADOS, your state can help you. You might be in that particular, especially if you're an ADOS here, your state might have an exemption for that income. If you happen to be one of those states like AKA Vermont, you might be able to get in a nice tax situation. So no matter what, the federal government's going to get you though. They don't have those exemptions. They'll get you. There's a great website that I did post the Teams page that someone provided for MOA. If you're looking forward to retirement and trying to figure out where do I want to go, there is a great scorecard that you can go look through to see what the state offers you for military retiree. When the rule of thumb, though, is when you retire from the military, you cannot maintain your state of legal residence if it's elsewhere. You must basically pause. Where am I living now? I now must become a state resident of that area. There are some exceptions that I've heard out there. I won't get into them, but just remember, you don't carry over your military benefits into retirement. It just doesn't work that way. Just want to make sure everyone understands that, because I don't want you to get a huge tax bill from your state, because eventually they will find you. Like, what happened to this person? This person's no longer military. I don't know how they get notified. It just happens. You'll get a tax bill. They find you. Vermont found me one year. I forgot to pay when a crossover year. I forgot to pay them, and they found me. They found me during COVID, so I guess they had a lot of time in their hands. So let me check real quick and see if there are any questions. All right, nothing yet. Come on. There we go. FICA, just SA, in case you wanted to know, Social Security is 6.2 and Medicare is 1.45. There is a time that you no longer have to pay Social Security, just that portion. Once you go above 184.5, you don't have to pay the Social Security portion, the 6.2. You still have to pay Medicare, but you stop paying Social Security. This is one of those tax things that you sometimes hear in the politicized world and the news of how we could fix our Social Security program by doing away with this cap, the Social Security cap, basically. I've done some math. If you were just wondering, it was at the New York Yankees at the time when Alex Rodriguez signed that huge contract. I figured out that his salary alone would contribute $3 million to Social Security. That's one person. Imagine the whole rest of the Yankees. Or look at those folks that I saw on ESPN, the Seattle wide receiver signed like a $30 million guaranteed, but like it's $100-something million contract. If they are allowed to take the 6.2%, Social Security will be fixed. It'd be fully funded forever by taxing our athletes and doing away with a cap. Just want to make sure you knew there was a cap, because eventually in your career, you might get to that point that you make more than 184.5 and boom, they stop doing it. And it goes up every year. Medicare, as I mentioned, you're going to always pay that. And that's the hospital insurance. You basically are paying Social Security and Medicare for people in the system now. That's how it kind of works. So right now, your kids, when they're full working, will be paying for your Social Security. So that's how it kind of works. We put it in, and Social Security is one of those amazing investments that you can put X amount in, and then how in the hell am I pulling this money out? It doesn't make sense to me on how they do it. I hope for the best for Social Security, but as I talk about in later things, we got to make sure we plan for the future. I'm not trying to be a downer, but Social Security is always in the news. I hope to collect Social Security when it gets to my time, but I believe it's going to have to change to be solvent and do what it needs to do for the people it's meant to. Background for Social Security, FDR started it. It was meant to care for people who had nothing. So us government employees are blessed with a pension. Not everyone has that. So it's really meant for those people who never basically are poor, that this is a safety net for them. And that's what Social Security was meant for, is a safety net. It was not meant for people, honestly, like us to pull from, but it's been morphed over the years. Just a little background on it in case you're interested. And if you're self-employed, you have to pay both sides. So there's both sides. There's an employer and employee version of this one. So the federal government pays 7.65 as well to the system. We pay to the system. So it's a double. So if you're ever self-employed in retirement, for example, you'll have to pay both sides of that. So just want to make sure, and there's also additional Medicare tax in there as well. But just want to make sure you all knew that, because a lot of people end up leaving the military. They go into self-employment. I just don't want you to be surprised that you have a big Social Security bill. Now, how do we reduce our taxes? This is what you all want to know. Number one, quit your job. If you're not making any money, they can't tax you. Take a job for less money. Have more kids. There you go. Have a large mortgage with lots of interest. Have lots of medical bills. Give lots of charity. Lose money in investments. Really what I'm saying is there's not really a good option how to reduce your taxes. So don't take really any of those. Have more kids if you want to, that's fine, but they're expensive in themselves. But I'm going to really show you how you can reduce your taxes in your paycheck so that you get more money in your paycheck to manage your budget, to save for the future, to save for your emergency fund, to live life, have fun, and enjoy. Really some better options. There are some better options on how to reduce it, and we'll get to that. There's credits and deductions and all that. But one way people do reduce their taxes is, I don't always encourage this one, but you could if you wanted to. It's called increasing your itemizations. If you understand the tax form, so you have your income, you have your deductions, so different things like some student loan deduction, teacher deduction, like my wife can take up to, I think, $600 a year for spending her own money in the classroom, which we spend way more money than $600. Different things you can deduct to get to a adjusted gross income. Then they take taxes off that. Then they do some more, take a standard deduction or itemization. So there are two ways you can approach your tax scenarios. You can take the standard deduction, which has grown substantially under the President Trump tax plan when he initiated it in his first term. it's not a good tax plan, in my opinion. When I did my analysis of it when it first happened, I ended up having to pay more taxes. So me being one income scenario where I was at lieutenant colonel, I was one income family at the time. I was paying more taxes than I was under the prior plan. The tax plan was really based upon children. Child tax credits were very large in the new tax plan. And that's how I lived and died. So as my kids got older, and I have a 22, 21, and an 18-year-old, as they got over and became 17 years old, they started falling off the child tax credit. And I started getting a larger and larger and larger tax bill. My tax bill is atrocious. It's almost as much as my wife's salary, it feels like, but not really, but it's really large. Just because I don't really have those credits and deductions I can take anymore. But the tax plan was great for the term DINK, dual income, no kids. They got a huge bump in the standard deduction. So for them, it was really good. I have cousins who are DINKs, and their tax bill went down considerably because of the standard deduction. Most people, I'll say, take it because it's now larger. Back under the old tax plan, you could probably get to the itemization limit, meaning if you can itemize enough tax items, and for example, let's say you're married jointly. If you can itemize enough tax items to get over $32,200, you can now use that to deduct from your income to pay less taxes. But because they raised it so high, most people now can't get to that standard deduction limit. Like I can't even get there. There's no way I could have got there. In the itemizations, which you can find on tax forms as Schedule A or B, one of those two, it's, for example, medical bills above 2%. So really in the TRICARE world, you don't have to worry about it because we don't really have many bills. So that's really not going to happen. Mortgage interest, you can deduct that. And every year that you have a mortgage, you probably get that tax statement at the end of the year. That can be itemized. You can itemize your property taxes. Sometimes if you pay special fees in your state for your cars, you can do some of those. Charity. So now they put charity, any money you give to charity has to be itemized. It's no longer a separate line item like it used to be. So that was kind of stinky when they did that. I think that's bad for the charities because now, I'm not going to say a lot of people donated because of tax deductions, but a lot of people donated because of tax deductions. That's not really a something anymore. And I don't know. Personally, I believe, in my opinion, it did hurt charities, but it is what it is. Understanding those, but I'll say on average, the most people I encounter will just take the standard deduction. But if you happen to have a large mortgage bill, interest bill, it's mortgage interest, not your mortgage payment, and you have a large property tax bill, you may find itemization might be better for you. But then also there's, once you get a little older, there's additional tax credits. And this year they installed for our senior citizen population a new credit, which I know when I did my parents' taxes, it went up considerably. They ended up getting a huge tax refund because of this new senior citizen thing. And then we're talking about take advantage of tax credits. Itemized, we kind of talked about that: healthcare, state, local taxes, personal property taxes, mortgage interest, and all those. If you don't have enough of those, the standard deduction is what you're going to take. But you need to make sure you keep track of all of these. So make sure you have a special folder when you give to charity. Like if you go to Goodwill, they will ask you, would you like a receipt? Always say yes, and they just give you a piece of paper. You have to fill it in. You have to fill it in. Make sure that you're keeping all these receipts in case you get audited. Let me see. I think we got a question here. If you don't itemize, you can. If you don't itemize, you can deduct. All right. And David? What's for what in particular?
So in 2026, charitable donations, you can deduct up to 1,000 individual, 2,000 for filing jointly.
Oh, fantastic! So there's a new tax rule. So glad you're up on it. That is great because before that was not the case. So fantastic. You just learned. We all just learned something there. So make sure you keep your receipts, because they always ask you anything above a certain dollar figure, make sure you have your receipts. And don't say your t-shirt is worth $25. You need to make sure you have good receipts that are adequate dollar amounts. Use AI, use the internet to say, how much is this item worth? Just because you paid $200 for a table doesn't mean you can deduct $200 for charity. Make sure you all understand that, because you can easily get yourself into tax problems if you say, yeah, I do $2,000, like for example, what David mentioned here, $2,000 every year, $2,000. And for some reason, your name comes up in an audit. Okay, what was the $2,000? If you gave a check, make sure you could download the check image from your bank, or if you have a carbon copy. Keep receipts. If, like, for example, if you go to church, most churches in the Catholic faith, because I was raised Catholic, that's really all I know, they have envelopes that they want you to stick the offering in that has your name on it. So at the end of the year, they actually send you a tax letter saying, thank you for your donation of $250. That's your receipt. So make sure you're following that mindset, because if everyone starts claiming, for example, here, $2,000, they might get you. I just want to avoid audits. I have received a letter from the IRS. One time I did something incorrect for my taxes. When we talk about IRAs, one of the things you can do for an IRA, a Roth IRA, for example, is you can remove contributions at any time. You must leave the earnings in the Roth IRA, but you can always take back your contributions. So I did that one time to pay a college bill. And I did it incorrectly, and I got a nice tax bill from the IRS saying you owe us like $26,000. I'm like, no, wait, time out. I had to show them all the proof and everything like that, and it all came out fine in the end. So, and yeah, it was fun. Receipts. Well, that's great news about 2026. And our tax software is really good. So when you go through Military OneSource, use H&R Block, it's going to help prod you along. If you use TurboTax, that's cool. If you use Quicken, TaxSlayer, all those other ones, they should prompt you for some of these things. Like, did you donate to charity? And just go through it. Don't go too quickly. Make sure you read everything and ask for help if you need to. Tax credits. This is where your most bang for your buck is on tax credits. Deductions don't always do dollar for dollar, because as I showed you in the marginal tax bracket, a deduction just subtracts $1,000 from your income. So for example, the $150,000, let me actually go back to that. So you understand the difference between the two. A deduction and a credit. A deduction reduces your taxable income, your modified adjustable gross income, MAGI, while a tax credit reduces your tax bill. So the difference. A deduction or an itemization would take $150,000, for example, and say we gave $2,000 for charity, and that's itemized now. It's a deduction because you can do it. Minus $2,000, $148 is now your taxable income. Did that change anything? All it did is it changed this $49,200 now to $47,200 taxed at 22%. It's not a dollar for dollar. Just want to make sure you understand that. A credit is a dollar for dollar. A child tax credit reduces your tax bill dollar for dollar. A child independent care credit does as well. Other tax credits will as well. If you didn't know, if you have a child in college and you are paying their tuition, 9/11 GI Bill does not count. If you're using your 9/11 GI Bill, or technically you're using tuition assistance, and you are not physically paying anything, you cannot use the tax credit for college expenses. I want to make sure you all understand that. But also, the tax credits for college expenses are very income based. If you make too much, you can't take them at all. So the first child tax credit is simple. If you have a kid, once the year they reach 17 is when they phase out of the full. But under the current tax plan, you get you do get money for your other kids, like $500. So you do get something for your other kids. It's just not the full amount. Child dependent care credit, that's for sending your kids to daycare. You have a credit for some of that. College credits, the first one, American Opportunity Tax Credit. That is one that you can do for the first 4 years of college, and they don't have to be consecutive. The other one is a lifetime learning credit, which is post-secondary, so graduate school or anything that can improve your job skills. You need to look into the IRS website for that improved job skills things. And you can take this as many times as you want, but you got to make sure you keep good records. All this is about good records. Saving for retirement credit. This is more for the younger in rank and the lower people in income, but they will give you a credit for saving for your retirement. If you do your 401k, if you do a Roth IRA, you put it in there and they'll give you money back. Adopting children, because it's super expensive, they'll give a credit. And the earned income credit is for our poorer population. They can actually get a credit back because they don't make any money. You probably have heard about that one. So how we can truly reduce our income, besides doing the tax credits and the deductions, but I highly encourage you to, when you're using your tax software, if you don't understand something, use the help function. H&R Block has an AI function now to help you. If you get yourself into a major pickle with your taxes, you might want to reach out to a professional, and this is just some professional advice. Your local person at your Jackson Hewitt or H&R Block knows nothing about taxes. They know how to press buttons. If you find yourself in a tax pickle, you need to find a certified public accountant. There are some people at H&R Block that might be certified public accountants or are professional accountants, but the average person who is working, like you can go file your taxes at Walmart through Jackson Hewitt, but that person is not a true accountant. They're just they've been put through a class on how to work the software. I'm just saying, giving it good advice, same advice I give to my children, and it's even in my living will, living trust. If you have any tax questions, please reach out and talk to a certified public accountant. They're the ones who are experts and they understand the tax law. How to truly reduce your income. Contribute to your traditional 401k or TSP. Definition time. Traditional versus Roth. And we'll talk more about this on, I think it's on Thursday and also Wednesday. Traditional means tax deferred. You do not pay taxes on traditional now. You pay taxes when you withdraw. Roth means you pay taxes now. You never pay taxes again. So making sure terminology. You can reduce your taxes by contributing to a traditional 401k. That will reduce your income. So if you put in $5,000 into traditional TSP, and you have to elect this when you go through the process of where you want it, it will reduce your income by $5,000, so thereby you're paying less taxes. What you will do then is when you hit 59.5, that is the minimum, with the exception of if you happen to be aged 54.5, 55, we'll just call it 55 to be unsafe. If you're 55, you have retired from your employer in which you have the 401k, you can then withdraw penalty-free at that time. Little caveat in the TSP 401k reg. But normal people will be 59.5. You will pay taxes then. So you reduce your taxes now, but you pay taxes in the end. And the whole purpose of the mentality of that is that you would pay less taxes in retirement because you have less money. So you should be in a lower marginal tax bracket. That's the whole purpose behind the traditional. That used to be the only thing that you had. Roth, pay taxes now when you earn full income earning, so you never pay them again. Looks like I had a question. Oh, no. Traditional IRA, you can also open one of those and reduce your taxes, but they have income limits. But remember, traditional does not mean tax-free, means tax reduction now, tax bill when you withdraw. Other work benefits, medical premiums, you can reduce your income, not on our side, more on the technician side or in the outside world. They sometimes allow you to reduce your income. If you happen to have a, drawing a blank, I'll remember it here. You can deduct some like insurance premiums you can deduct as well. Survivor benefit program. I talk about this in the pension class for the military folks. If you elect to do survivor benefit program when you retire, it is pre-tax. So it has then reduced your taxes. For example, when I take it, it's roughly about a $6,000 bill I'll be paying every year. So instead of me being taxed on, I think it was $92,000 is my potential pension, I'll be taxed $6,000 less, about $86,000. So that's good. It reduced me marginally. And then there's also tax beneficial investments. There's things called municipal bonds that can help you reduce taxes. We talk more about that in future classes. Let me take the question there. I like flexible savings accounts. I really think that's a great thing that they opened for the military. So the flexible savings accounts allow you to put money in for medical bills. I used mine all the time when I was a technician. I absolutely loved it. I think they're great because they do reduce your taxable. So the flexible savings accounts, you put money into them and they reduce your taxable income, and then you can use them on medical items tax-free. So basically it's a tax-free, like a pair of glasses. You can go to Costco and then you go make a submission to your whoever's managing the account and they'll pay you back for the glasses tax-free. I love it, but you just have to make sure you watch your limits because I know you can carry over a certain amount. You just don't want to carry over too much. But if you happen to see at the end of tax year, you go into Costco, sometimes they'll have under like ibuprofen or Aleve, use your flexible spending account on these. Don't forget. I think it's great. As long as you have those medical necessities that it's for. If you're saving up for LASIK, for some reason, I don't know why you're not getting for free. The military won't pay for LASIK, so you want LASIK. You can put money aside for LASIKs for that. Different things like that. Invisalign, if you want Invisalign, you could do that for that. I personally like them. A good question. And that's another way you can reduce your income with the flexible spending accounts. And more money, this is where we're going to get to the hands-on. I'm going to walk you through how to reduce your your income tax. If you didn't know, you can physically modify the amount of taxes they take from your paycheck. I'm going to show you how to predict what your taxes will be so that you're not giving the IRS an interest-free loan. So right now, if you go into the tax system and you don't do anything whatsoever, they're going to pull taxes based upon, we'll say one person, if you're single, two people, married, filing jointly. They don't know if you have kids. You have to tell them you have kids. They're going to tax you fairly high because you're not doing anything. It's the default. When you start a new job, most of the time they'll ask you to do a tax form so that you can adjust yourself. You can go into your financial office, whether it be outside the government or inside the government. You can go ahead and fill out a tax form in person or online through MyPay. You can go to your local comptroller and fill out a new tax form if you want, called a W-4. That is how you can modify it. I'm going to show you how to predict it and then how you would actually go into MyPay and kind of mess around with it. But if you're not doing that and you're just letting it run on autopilot, you're giving the IRS an interest-free loan, meaning they're taking your money, using it as revenue, and they're going to give it back to you eventually when you file your taxes. But think about it, if you're not adjusting your taxes, you could be giving them thousands of dollars that you could be doing things with. One, working on your emergency fund if you don't have one. Working on a savings account for... All right, hot mic there, just check your mics out there. Using it to contribute to TSP, IRA, setting up saving for college for your kids. All that money's out there that you could do stuff with it now, earn interest on it now, versus getting it back as a large refund. And then most of the time people, this is just majority of people I hear, they blow it on things. They could be having that every month to work into their budget, to save properly, save for the future, plan for meeting goals, and go on. It gives your budget vital information to truly work on what you're paid and what you should be paid in your checking account versus letting the system run wild. and allows you to save for the extra. This will reduce your refund or maybe give you a small bill depending on how close you get. But what I'm going to show you is just getting your money earlier than getting it back in April or May, whenever you decide to file. I file in January as soon as possible. I got my money back really quickly. It looks like the IRS has been giving the money back fairly quickly here versus in the past it's been a little slow. Don't give them an interest-free loan. My parents ended up giving them $13,000 because they didn't know about the tax law. That changed. That's a mistake. But don't give interest-free loans. You could do something with that money. Reference Basic Savings on savings accounts when I actually get the video uploaded to talk about how you can earn more interest on your money. All right. This is some references. We're going to go to the withholding calculator. Paycheck City has a great way for you to kind of mess around and figure out your tax liability as well. Dinkytown.net. Don't worry, that is a good website. It sounds like a dirty website, but no, it's a good website. Has great financial calculators, and especially in the taxes section. And also Smart Asset has options as well. So we're going to go live. I'm checking for no questions. All right, that's why I'm asking Teams why I can't upload my video. Come on. Come on. There we go. Can you all see the IRS website?
I got you, sir.
All right, thank you. And you see why I'm like, why won't this upload? Why? Come on, I just want to move that over. All right, it's just gonna stay. You can go to the IRS website directly. I always just type in withholding calculator, withholding estimator into Google or whatever, and it takes you right there. You have to go to the IRS website. And this is what you want to look for. This basically is a tool that you can estimate to help you complete a W-4. You can do your W-4 manually, but really you can just use MyPay and do it right through MyPay so you don't have to worry about it. What you're going to do, we're going to say we're going to start your estimate. I'm going to show you what I do. This is not what everyone does, but this is what I do for simplicity. When you start getting multiple incomes, it gets a little difficult. So the great thing about the military is we have a quick ability to adjust our taxes, and also our government employees. Very easy to modify our taxes. My wife, again, teacher, Spotsylvania County. If she needs to change her taxes, she's got to contact HR and do. It's very complicated. So what I personally did, again, this is just what I do. I make my wife exempt from federal taxes. And I use my salary and I pay all the taxes for both of us. Because it doesn't matter who pays the taxes as long as the taxes get paid. Because I have the ability to manipulate my taxes super easy via MyPay versus her. So if you're in a situation that you have dual income and your spouse doesn't have a very easy system to use for taxes, I'm just giving one way you can do it. You just make them exempt from federal taxes. Most likely the state tax they're going to have to pay unless you are paying taxes, because sometimes it's just the military, not the spouse, that gets the benefit. Be very careful in all that. But I will show you some different ways to do it. Will you be 65? No, I won't. Are you blind? Nope. Now, this is an important part. Do you plan to claim dependents on your 2026 tax return? If you're in a situation that you have kids who are working, this is where it gets difficult. They may go ahead and say, yeah, I'm just going to, when they file their taxes, they're going to claim themselves as a dependent. They don't know about these things. So that part of this is education. When they go through their taxes, I'm hoping you're helping them with it, because your kids can get it free as well through Military OneSource. Make sure they click no, that they're being claimed as a dependent on someone else's return. Because most of the time, unless your kid's making big bucks, they don't have to be their own dependent and they still get all their money back. Sometimes it's more profitable, I say profitable, meaning on our side, to reduce our taxes as the parents to make sure we claim them as a dependent. Again, I have 3 kids. One's an adult on their own. Another one still lives in my house, and I provide basically everything for them as they finish up college and they're working part-time. And my other kid is a full-time college student as well. I claim 2 dependents on them. So when they file their taxes because their employer, when they did their forms, they were taxed. When they do their taxes, they're going to make sure they say someone else has claimed me as a dependent. When my daughter, who is 21, does that, she still gets all her taxes back because she only makes $10,000 a year. So you have to make sure you understand when it's beneficial for them to claim themselves versus when it's beneficial for you to claim them. So I'm going to claim dependents. Come on. And see right here, can you be claimed as dependent on someone else's tax return? I can't, but my kid would say yes. And what status? I'm going to see all the different statuses you can do. And they have a great little question. Which filing status should I use? Come on. Fair and joint. And then fill out the same for your spouse. And this is where you need your last paycheck. You're going to add your job. So I'm going to job myself. So again, I'm just going to do for simplicity, just to show you what I do. Doesn't mean everyone should do it, just to kind of give you an example on how to use this. I have a salary, but you can do hourly if you wanted to. All year, for example, I get paid all year. For mine, this one will be really tricky for me to do, but I went ahead and modified my taxes already because I'm retiring at the end of the month. We get paid, for me, honestly, this is just my opinion, I do once a month. I recommend military folks do this. Technicians, civilians, a little different. They could do every 2 weeks because they get an LES that's complete every 2 weeks. We in the military, the 15th monthly advice payment stinks. Doesn't have any information. If you select once a month, you'll have all the information you need to fill out the forms. So military, once a month. Federal service, every 2 weeks. Just want to make sure you understand the difference. And then what you'll do is you'll select when was your last recent pay period. I'm going to say February, and at 28, I don't know if I had 26 days. My recent pay stub, February. So right now, if I was you, I would just wait until past April 1st, because it doesn't like when you go ahead in time. So like, for example, if you got your LES tomorrow, you might get your LES Sunday. I don't know if it's when the cutoff is exactly. If you get your LES now and you try to do it for the end of March, it's not going to like it. So wait till after March ends and you can input March's data at that time. But since we're paid once a month, we're doing February. What's your gross income? Gross income. Again, remember, BAH and BS do not get included in this. So my gross income, let's say my base pay, let's just say it's $10,000 per month, just to keep it simple, but you would get this from your LES. So I'm going through 2 months. So my gross income for this pay period was $10,000. Did I receive a bonus? No, I wish. And if you had a bonus, you put that in there. What's the gross income you have received so far? Because we are only paid at the end of the month, I'm going to put $20,000. You can put tips and overtime, not an issue for us in the military, but civilians, you go put estimated overtime in there. Federal taxes. Use your most recent pay stub to enter the information. How much for this pay period? So I'm just going to say I had $2,000. Again, this is all from your LES. You would find it all from your LES. Federal taxes withheld so far. Where you would find this in your LES is not in the top section. You have to go down into the bottom section right above the remarks. There's all these little columns and rows. You're going to look in federal taxes year to date, YTD, and it's going to say that right in there. And you're going to find it in there. If you haven't gone through your LES with a fine-tuned comb and read every box, there is an abundance of information in there. One, tells you how you're paid, what you're paid for, and tells you all about how much you got paid this month, how much you got paid year to date, taxes year to date, TSP year to date, tells you all this great information. So contributions, this allows you to, if you happen to be doing a traditional TSP, you can put it into retirement plans. If you have tax deductible insurance, you can put it there. The flexible spending account, you could put it in there. You put all that information in there easily just by clicking here, and boom, it tells you you could do this one. Remember, it must be traditional, cannot be Roth to get it reduced. It allows you to do all that kind of stuff as well. And because this is just my example, I would include my wife in the income. So I'm saying I made $10,000. What I would do is just add my wife's in there. So let me go back and do that. So my wife, we'll just say she makes $2,500 per month. She makes a little more than that, but not too much. So I am now at $25,000. This is for my family. I have one job for my family. I combined, but again, you can do for both your family. That's fine, because your spouse and you most likely have different MyPay accounts, right? That means you can modify your taxes each. So federal taxes, because I'm paying them all, I just put what I paid recently. I have no contributions, and that's all I have. I could add another job if I wanted to, but I'm not doing it just for simplicity. And this is pretty easy to use, but can get complex depending on what you want. If I had a pension instead of a job, remember, a pension is not a job. A pension is deemed unearned income. Well, a job is a earned income scenario. That's why you have difference. So when I retire, I'll do, like for my example for this year, I would have a job for 3 months and unearned income for the 9, but my wife would have it for all year long. So it'd be a little complex for me to figure it out, but I'm going to have fun and do it. Self-employment income, if you have any in there, Social Security, if you have that, but we're talking about us normally. Unemployment income, if you have any in there, pre-tax retirement account income, investment income. Builds on our basic savings. If you have any savings accounts that you're earning money on or earning interest on, you would put that in here. Interest income. Your savings account interest will be charged. Will be charged taxes. So you'd put that in there. Okay. I expect to pay $5,000 on my savings accounts. Are you expecting any dividend payments do you have a personal investment? You would put it in there. Short-term gains and losses. That's where, if you're into the stock world, you understand what that is. I'm not going to explain that very much for the basic 80% solution. But if you know you have short-term gains or losses because you sold a private investment, you would know where that belongs. Royalties. If you happen to have a podcast, a YouTube, a book, you'd put royalties into that because it's all taxed. Any other taxable income not included. If you have anything that's deemed taxable, gambling winnings, if you actually received a statement from the casino that you won money. For example, my mom, actually, she goes to West Virginia. They go like every month just to play the nickel slots. She won $13,000 from a slot machine. She would put that in there. And then put other information, and then any estimated taxes. If you're not doing well with your taxes, you could go ahead and do estimated tax payments, but we're not going to talk about that one because you'll know if you're in that situation. Adjustments. If you know of any adjustments that you know, if you have student loans, you can put a student loan deduction in there. Educator expense up to $700. I know that my wife is working all year, and I know we always max it out. I'm putting it in there. If you have a traditional IRA, you could put it in there, and just remember it's very income based. So if you make too much, you might not be able to deduct it. Health savings account deduction, which is already on the other one as well. Alimony. If you have any penalties for any early withdrawal from like a CD, moving expenses, just be careful with those. If you very dangerous about claiming moving expenses, because really if the government moved you, you probably shouldn't have any bills. If you did a Diddy, you probably shouldn't have any bills because they paid you. But just be careful with that one. I see a lot of people use that. This is where you can choose your standard deduction or itemize. I'm just going to do standard deduction, but you can put your itemizations in there. And anything additional you would put, this is where you do charitable. So that's where David mentioned. So I will say I do $1,000. Car loan deduction, you spouse. Let's see, what's the new one? That's a new one. So car loan interest deduction, if you have any of that, you could be able to do that. That is a new one. That's awesome. Other qualified business income. So this has changed since I just looked at it a few months ago, but I guess this is 2026. And this may change as tax law changes. This may change. Here, this is where you can do a child tax credit. How many kids do you have? You can put in I'll just put in 1 just for simplicity. Other dependents, let's see. No, I'm going to say no on that one. Any college? I know I'm going through this fast because we're running out of time. All these other things. This is everything you can put in here. Look at all this stuff, and it explains what it is, and then boom, gives you results. My estimated tax bill for the year is $10,000. So what you now do is you're going to go into TSP, and you're going to. All right. This is where I know we're over time, and this will be, if you need to drop off, fine. That's perfectly fine. I understand. Reach out to me. My email address, I will put real quickly before you guys drop off because I know I'm going late here. There's my email address. Happy to answer any questions you may have on anything. I will post this video to the Teams channel for me to cover the last 5 to 10 minutes. And I'm sorry for running late. And I will get to you if any questions you may have, but we'll finish up, and then you can listen to recording at double time for the things you missed. I apologize. So how I recommend doing this personally is you want to go into MyPay itself, look at your last tax bill that you had on your LES. So if your LES has, I'll say my LES has $2,000 for taxes. I can easily do, if I do $2,000 every month for 12 months, that's $24,000, right? I'm paying way too much. And I'm factoring my wife's as well at the same time. What I would do is I would reduce my taxes, and there's a way you can do it in MyPay that I won't have time to show, but you can go into MyPay and you can add in different things to reduce your taxable thing. And the good thing about it is it's trial and error. As you go through MyPay and you put in the numbers, check the next LES, check the next pay stub. If it didn't do what you wanted it to do, just go ahead and make the modifications the next time. It is a trial and error scenario, and I recommend doing this estimate every quarter and then balancing your LES every quarter to your tax bill. So what I always did is I did my taxes. I knew roughly what my wife was making per year, added our incomes together, did everything going across, and I would look at it every quarter because I would have a better estimate on how much my interest in my savings account was. Put that in there. Okay, I got my tax bill. Do I need to make a modification in my LES through MyPay? All right, no, it looks like I know how much I'm going to collect. Okay, good. And kind of move on and do it every quarter. And this used to give you, which it doesn't now. Okay, here it goes. When you actually click on this, your calculation, go ahead and look through it. Again, this just changed, added some things recently in the last few weeks. Sorry, I'm going on. It says your estimated tax liability based upon the information I provided. It's going to say that my estimated tax liability is $16,000. Based upon my federal withholdings of $24,000. Remember, I am putting $2,000 away every month. Based upon the income I provided, my refund is going to be $10,000. What your goal is to, as you do this every quarter and rebalance, you want to make sure your estimated tax refund is as close to zero as humanly possible. I try to get it around 1,000 and under is what I go to. That is just a warm fuzzy for me to not get too close to have a bill. Have I paid bills? Yes, but they've been very minor, like $300. Your goal is to get that tax refund as close to zero as possible with your comfort factor in there. And by putting all your information via your LES into this estimator, you can then take the information, go into, if you go ahead and click on this here, this actually lets you do one, but it doesn't do it via MyPay. So it actually will walk you through the process and how to do it. So I know I rushed through that really quickly, but please go ahead and use that to help get the most refund. Someone's got a hot mic out there to get the best, lowest refund as humanly possible. I know it's kind of confusing, and I hope to answer any questions that you may have. Anyone have any questions? I will stay on I will stop recording just to make sure that any of your questions, if you don't feel like they want to be recorded, but I went through that quickly. I gave you a tool you can use to help get your refund down to next to zero. And what that's going to do is get more money in your monthly paycheck, in which then you can use it for savings, an IRA, increase your TSP allocations, put money in a health savings account, put money into a personal mutual fund, put money into personal stock, put money into your Roth IRA, your spouse's IRA, saving for college. All this money you can have now in your monthly budget to do great things with, versus waiting for that $10,000 refund. That $10,000 refund is, you just gave them $10,000 with no interest. You could be earning money on it. So I'm going to stop recording, but I will stay on for any questions you may have. Let me stop recording real quick here. I have stopped recording. Stopped. I'm